All right, welcome to Talkin' Investing. I'm Tom, and as always, this is not financial advice. Today, I want to talk about Volta Inc., stock ticker VLTA. Volta is in the EV sector. They are an EV charging station play. They're a small cap, high growth company. So we talk about companies like this all the time on the channel. So if you're new to the channel, please remember to subscribe and hit the notification bell. Also, if everybody would smash the like button, that would help out the channel a lot. I really appreciate it. Lastly, you'll see in the pinned comment a link to our free Discord. So we're revamping the Discord, and we got some exciting things coming over there, so we'd love to have you join us. With that said, let's take a look at Volta. Okay, Volta has had some serious price action on their stock over the last few days. They put out a press release 2 days ago. I want to go through that press release, talk about why it had such a big impact on their stock and what has changed, because I believe something has fundamentally changed and the risk on Volta stock has increased. So full disclosure, I do own Volta stock and I am not selling my shares. However, when the risk profile of a company changes, that's an important conversation to have. So I do want to go through that and tell you why I think the risk profile has changed and what it means to their stock and what it means to their company. Okay, so let's start out with the press release. All right, this was on June 13th. So that was Monday, and Volta was down 25% on Monday. So that is an enormous move to the downside. Monday was not a good day in the stock market overall, but down 25% is definitely an outlying event. That is a massive down day. At first glance, this press release does not seem to be that concerning. However, obviously, between the bad day in the market and this release, some triggers may have kicked in and this stock sold off very hard. Volta Inc. Board of Directors announces executive leadership team additions and key promotions. First summary line above the actual article, Vince Cubbage, and I apologize if I'm butchering that name, appointed interim chief executive officer. So before I get to the rest of the press release, I think this was a gigantic disappointment, not because people have anything against Vince, but because this press release came out just 2 months ago. Volta Inc. appoints Brad Hastings interim chief executive officer. Volta has a void here at the CEO position, which obviously is the critical position in the company. So they have already announced an interim CEO, and this was just 2 months ago. So it's now 2 months later, and where the market is expecting them to announce a permanent CEO, this has been one of the big things holding this stock back, in my opinion, and there are others which we will go through. Instead of getting a new CEO, we've got a new interim CEO. Well, they already had an interim CEO, so I think that was disturbing to the marketplace. What investors want to see is a highly qualified individual with experience in this sector and some type of track record of success that lets them know that they've got a person at the helm that's going to steer this ship. Moving from interim chief executive officer to interim chief executive officer is not encouraging. In addition to that, I'm not going to read this whole thing, but they added several positions at the executive level. I also don't think that is what investors are looking for. This is a company that has some cash flow constraints, which we will talk about, and just layering up upper management. I'm not sure that's what the market wanted to hear. I know that's not what I wanted to hear. Now, ordinarily, this would not be that big a deal. Yes, this is not the exact press release that I was looking for, but, typically, this would not send shockwaves through a stock. However, with everything else that is going on, that is what happened. This company is suffering massively from a general shift in the overall market. 2022 has been a nightmare for small cap high growth stocks. Actually, it's been a nightmare for almost every stock other than in the energy and pharmaceutical sectors. This has been going on for over a year now, and it's accelerated drastically in 2022, and most specifically in April and May of 2022. These small cap high growth stock companies got destroyed. And that's what I want to show you, and that's why I believe the risk profile of this company has changed. The drastic reduction in the price of their stock, and it was not specific to them. This is across the board. There are many companies facing the exact same situation right now, where 3-4 months ago they were looking at one scenario, and now with the drastic downturn in April and May, they're looking at a totally different situation. So we're going to get to the chart, and that's going to be a big part of this puzzle, because one of their main problems is their stock price has plummeted so dramatically, it's going to be hard for them to raise the capital that they may need over the next few years through equity, because these stocks are now beaten down to a point, and once they get this far beaten down, down, big money hedge funds start to pile on and see if they can drive them down to zero. So it looks to me like Volta has shifted into that category. Now, that doesn't mean they're going out of business. I'm not saying that. Like I said, I own this stock. I'm not selling this stock. Having said that, this is not financial advice. The whole point of this video is the risk profile on this stock, in my opinion, has changed drastically, and it is a much riskier stock to hold right now than it was 3 or 4 months ago, in my opinion. Okay, first I want to start out by talking about cash flow. So last year, at the December 31st financial statements, they had about $260 million of cash. So those financial statements came out, I think, in April of this year. So with that being the most recent information and the stock price being what it was back in February and March of this year, that is when I entered this stock. So it had a certain profile at that point that I think has changed drastically. So if you look at these financial statements, the December 31st financial statements, this is their statement of cash flows. And for this company, it is all about cash flow because their cash burn and cash runway is what is concerning me. That was not a concern to me back at the beginning of April. And the reason for that is their stock was trading at a price where even just maybe a 10% dilution in their stock would provide them with probably another year's worth of cash. And they already had a few years worth of cash. So when you're looking at a startup high growth company like this, typically you're not that worried if they have a couple of year cash runway. But the market has changed drastically. And unfortunately right now, I don't see too much optimism out there. I don't see it necessarily changing back anytime soon. So this company is not in imminent risk of going out of business. I don't want to say that, but I do want to say the risk, in my opinion, of them not making it to the finish line, suddenly that's a valid conversation. Whereas to me, 3 or 4 months ago, that was such an unlikely scenario that it was not enough to change my buying decision on this stock. So if you look at their year-end financial statements last year, you'll see that they had a net loss of $276 million. So that sounds like a big net loss. However, once you go through the statement of cash flows, you'll see they use $93 million. So that is not $276 million. That's a drastic difference. So with a $93 million cash burn from operations and $260 million in the bank, it looked like there was a cash runway of 2 or 3 years. It also looked like, based on the price of their stock, they had the ability to maybe double that runway through some stock dilution. Although that is not ideal, obviously you want to survive as a company, and they were well in a position to do that. That has potentially changed. So fast forward, they have now put out their first quarter 2022 financial statements. This is their March 31st balance sheet. So you'll see they still have a very strong cash position, $205 million of cash. There's $234 million in current assets. There's $448 million in total assets. Almost none of that is intangible goodwill stuff. This is all actual property, plant, equipment. They have $94 million in current liabilities. So that is a strong current ratio. So again, they appear to be healthy when looking at the balance sheet. Their total liabilities are $197 million versus total assets of $448 million. So a very strong ratio, still over 2-to-1 ratio. So again, for me at a glance, this does not necessarily raise any red flags. Okay, so if we go through their operations, you'll see this company does not make money. Now, they lost $60 million. I will tell you $20 million of that was non-cash, and that was their depreciation and non-cash compensation. So again, when we go to the cash flows, you're going to see they didn't spend $60 million in cash, but they did technically, from an income statement standpoint, they lost $61 million in the first quarter. Then they had some other non-operating activities that were also non-cash, and that essentially brought their total comprehensive loss to $48 million for the first quarter. But if we go to the statement of cash flows, you're going to see that this $48 million of loss turned into $33.8 million of net negative cash flow. They do have $205 million in the bank even after that. So again, they are not on the verge of running out of money. This company is not about to collapse, but I will tell you that in their December 31st financial statements, the auditors did put in what's called a going concern risk. So that is a risk that there's the potential over the next 12 months that this company won't be able to meet its obligations. So, as a byproduct of that, there's the potential that they could go out of business. Now, small cap, high growth companies that are early stage very oftentimes have going concern notes in their auditor's opinion. They address that in note 3, I believe, of their financial statements, and they acknowledge that that exists. All right, I'm going to spend just a minute here on the Volta one-day chart. So they were just under $13 a share. In December, there was a precipitous drop. They were down to $7.38 by the time the year 2022 began. So at $7.38, a share, a stock dilution of 10% for this company would have raised them $70 million. Even though their stock was down about 48%, so close to 50% at that point, they still had an awful lot of equity and an awful lot of potential to raise money if needed. But in addition to that, at that point, they also had $260 million in the bank, so there was no imminent need. So you see, even if we fast forward all the way to March 21st, they were still trading at just under $5. That's this purple line right here. So again, a 10% dilution was going to get them $50 or $55 million, and they did not need the money on that day. However, this may have been a good time in hindsight. This may have been a good time to go grab $50 or $100 million. It would change their financial position drastically. And yes, shareholders would have been very disappointed and upset, and their stock price would have gotten hit. However, their stock price has gotten decimated anyway. So now as they sit here today, they're now at $1.59. So their ability to raise capital through equity is diminishing. That is becoming less and less of a viable alternative. Yes, they still can do it, but now they're going to have to do a 20 or 30% dilution just to get to where a 10% dilution would have got them just 2.5 months ago. So that is the fundamental change that has happened in this company, in my opinion. Volta is not in imminent danger. They're not going out of business this quarter or next quarter, but their risk profile to me has changed dramatically, because the thing is, they're at $1.58 right now, and I don't see what the catalyst is for this to turn around. It doesn't look like the market's turning around anytime soon. So what Volta is now dependent on, instead of being independent, they are dependent on a shift in the market to a more risk-on environment where money starts to move back into these small cap, high growth stocks. Now, the good news with this company is this is an EV charging station. The federal government has thrown its full force behind this. They're putting billions of dollars into this. So they are in a great market, and their growth is huge. There's 6 analysts covering this, and they anticipate in this year, 2022, 125% growth in revenue, and in next year, 2023, 107% growth in revenue. So these are gigantic numbers. To have a compound annual growth rate of over 100% is the definition of a high growth stock. So from this perspective, in almost any other market, I think this company would be in a decent position. Now you'll see they're losing money. They lost $4 a share last year. That looks like analysts estimate that's going to go down to about $1 a share this year, which they need to approach profitability as soon as they can. So I still believe, based on the fact that this is one of really only 4 major pure play EV stocks, and with the federal government and a lot of state governments behind this, and the massive shift we are having into the EV, these are one of the players that are going to do that. So for that reason, I'm holding the stock. But again, this is an absolute extremely dangerous stock, and I do think the risk profile has changed. So I just wanted to put something out there pointing this out. So be careful with this one. Please do your own due diligence. This stock continues to hit 52-week low after 52-week low. They were down 25% in one day just 2 days ago. So that's all I've got for you on Volta right now. Thanks so much for watching. Remember, if you made it this far, please subscribe to the channel and smash the like button. Thanks so much for watching, and we will see you in the next video.